Somewhere between 30 and 120 days before your policy expires, a letter arrives. It isn't a bill. It is a notice that your insurance company has decided not to renew your coverage at all. Not because you filed a claim, not because you did anything wrong, but because an algorithm somewhere decided your home now sits in a category the company no longer wants to insure. This letter is arriving in more American mailboxes than every year, and increasingly in places people never expected to receive one. It's worth distinguishing this from a cancellation. A cancellation ends your policy before its term is up, typically for missed payments. A non-renewal is different and, in some ways, more unsettling. Your insurer simply declines to offer you a new policy once your current one expires, even with a perfect payment history and no claims. It's the insurance industry's version of a business quietly deciding a customer or an entire zip code is no longer worth the risk. The pattern in the states most associated with this crisis is stark and well documented. 9 separate Florida insurers failed entirely between 2021 and 2023. State Farm and Allstate have both stopped accepting new home insurance policies in California, especially because of wildfire risk. At least 20 insurance companies have pulled out of Louisiana in the past 2 years. Florida's average non-renewal rate reached 3% in 2023 and 2024, triple the national average. And in 3 specific Florida countries, Henry, Okeechobee, and Glade's non-renewal rates in 2022 hit 24 to 33%. Here is a finding that deserves more attention than it currently gets. A U.S. Senate Budget Committee investigation found that non-renewal rates are rising in regions not traditionally associated with climate vulnerability at all. Southern New England, parts of Montana, coastal and inland North Carolina, coastal New Jersey, New Mexico, South Carolina, and even Oklahoma. This is not confined to the states that dominate the headlines. The insurance market is quietly repricing risk across the entire country, and the geography of that pricing is expanding faster than public awareness of it. The cumulative effect of rising costs and shrinking availability has produced a genuinely striking statistic. A 2024 Consumer Federation of America analysis found that 1 in 13 American homeowners is currently uninsured, leaving at least $1.6 trillion in unprotected market value. For most middle-class American families, a home represents their single largest asset. This statistic means a meaningful share of that asset class now sits with zero financial protection against the exact disaster becoming more frequent. When private insurers leave a market, most states operate a backstop, a state-run insurer of last resort program funded by policyholder fees and government support designed to cover homeowners no private company will touch. These programs carry real structural limitations worth understanding before assuming they solve the problem. Research from First Street Foundation found that premiums through these last resort programs are often multiple times the cost of the private policy they replaced. While providing meaningfully less coverage, California's state-run FAIR plan requires a $1 billion bailout following the 2025 wildfires, a clear signal that these backstop programs are themselves under genuine financial strain, not an unlimited safety net. The underlying economics driving this retreat are, from the insurance industry's own perspective, straightforward risk management rather than opportunism insured losses in the United States reached $112.7 million in 2024 alone, a 36% increase over the prior year. Average home insurance premiums surged roughly 30% between 2021 and 2024, significantly outpacing general inflation over the same period. From an actuarial standpoint, insurers are responding rationally to a genuine increase in the frequency and severity of claims. The consequence, regardless of how rational the underlying math, falls directly on homeowners who now face a shrinking, more expensive, and less reliable market for a product most mortgage lenders largely legally require them to carry. The downstream effects reach well beyond the insurance bill itself. Rising insurance costs directly increase monthly mortgage payments, since most lenders escrow insurance premiums as part of the payment itself, meaning an insurance non-renewal can trigger a genuine affordability crisis, even for homeowners who never miss a payment. In markets where insurance becomes difficult or prohibitively expensive to obtain at all, property values themselves face downward pressure. Since a home few insurers will cover becomes a home few buyers can realistically finance. Insurance has always functioned as a quite largely invisible signal of risk. Most people never think about it until the moment they need it. What's happening now is that signal becoming loud and visible for the first time in a generation, as an entire industry recalibrates zip code by zip code, which parts of the country it's still willing to stand behind financially. That recalibration is already reshaping where homes are affordable to own long before any flood or fire actually arrives. Thank you so much for your presence. I'm looking forward your feedback, your questions, your reflection. Feel free to let me know if you'd like any further clarification or you have an opinion that you'd like to share. Feel free to leave it in the comments and engage proactively in a meaningful discussion. And if you are yourself being subject to such kind of insurance limitations, let me know your unique situation, and perhaps you have an advice everyone else can benefit from.